Hi, everyone. Thanks for joining me today for this webinar covering terminations for convenience. So, it's August 2025, and we've seen a pretty dramatic increase in federal government contract terminations this year. Now, Deltec posted a spreadsheet tracking termination statistics recently, and between January and July of this year, there were over 30,000 terminations, and most of them were terminations for convenience. Now, there are a number of factors that may be contributing to this, including contract terminations that were instigated by DOGE or the Department of Government Efficiency. And all the signs are pointing to there being no let up for the foreseeable future. And in fact, there's every reason to believe that the termination rate will hold when you consider contract terminations that are expected to take place under GSA's consolidation program that was initiated earlier this year. Now, for a good number of contractors, particularly small businesses that are recently entered the government contracting marketplace, these terminations are completely new and for some, a fright inducing experience. So, today I just want to give an overview or introduction to the most common form of termination that's happening, and that's terminations for convenience. Now, in this introduction, we're just going to go over a few highlights or main issues that contractors should be mindful of. And in particular, we're centering on one of the issues that may matter most when a contractor receives a termination notice, and that is how are we going to get paid for the work that we've done? Now, as with our last webinar, there's just too much information in this introduction to squeeze into a video blog, so we're going to present this in a webinar format. Now, before I get started, I just want to say a few quick words about me and my law firm. So I've been a practicing attorney for over 20 years, and I'm the founder of the Amadeo Law Firm, and the firm's primary focus is on federal government contracting. So we help our clients with all of their government contracting legal needs, and that includes issues related to contract compliance, teaming with partners, and protecting technology that's used or developed under their government contracts. Now, there's more information about me up there on the slide and on our website, and we'll be providing you with my contact information at the end of the presentation. So if you have any questions on any of the information that I'm presenting today, feel free to reach out to me after the presentation. So the rules under FAR provide that the government can terminate a contract in one of two ways. First, if the contractor fails to perform in some way, whether it's providing services or doing work or delivering supplies, and if the contractor fails to cure that failure within 10 days, well, then the contracting officer can terminate the contract for default. Otherwise, the government can terminate a contract for convenience when it's in the best interests of the government. Now, the rules don't specify the circumstances in which it's the best interest of the government to terminate a contract, but what this effectively means is that the government can unilaterally terminate a contract at any time without any fault of the contractor and when the contractor has done nothing wrong. So, we're going to focus today on terminations for convenience because, again, they seem to be the most common terminations that are happening. So, when a contractor gets a notice of termination, especially if it's been performing well under the contract, the first reaction, understandably, is well, there must be something wrong here, and there has to be a way for us to challenge or stop this. Now, unfortunately, for contractors in this situation, the courts have recognized very limited grounds for challenging a termination. And generally, the courts will uphold the challenge when the termination has been brought either in bad faith or when the agency has abused its discretion. Now, I've listed some of the circumstances where bad faith and abuse of discretion can be found, but I don't want to spend much more time talking about them in this presentation because, first, the grounds are very nuanced and depend on the circumstances of the case, and they're better left for a separate presentation or webinar. But more importantly, especially for small businesses with finite resources, in order to present a credible challenge, the contractor faces some pretty steep burdens. And in some instances, the evidence that it presents is going to have to be nearly irrefutable. So, in many, if not most, terminations for convenience, the evidence is just not going to be there. So, the rules under FAR on contract terminations are generally found in FAR Part 49. And so, the contract clauses that incorporate those rules are in the 52.249 clauses that are listed up there on the slide. Now, I said generally because there are separate rules under FAR Part 12 that cover terminations of FAR Part 12 contracts, namely commercial contracts. Now, the termination clauses for those contracts is in FAR 52.212 that's listed up there on the slide. Now, the processes and procedures that a contractor will have to follow when it receives a notice of termination for convenience will vary depending on the contract and the actual clause that's inserted in the contract. But in this presentation, we're going to focus on the three most common terminations for convenience, and that's terminations for convenience of fixed price contracts, terminations for convenience of cost reimbursement contracts, and terminations for convenience of contracts for commercial products and services. So, just a few words about termination notices. Now, regardless of what type of contract is being terminated, which clause is inserted, or which kinds of terminations are being implemented, the rules for FAR Part 49 require the notices to contain certain information. Now, first, they have to specify the type of termination, whether it's for default or convenience. They also have to indicate the effective date of the termination, and they also have to specify the extent of the termination, whether it's a partial termination or a complete termination. Then, if the agency has any special instructions for the contractor, they should be in the notice. And then, if it's expected that the contractor will have a significant reduction in its workforce, well, the agency should include any steps the contractor should take to minimize the impact on personnel. So, in this presentation, we're going to start first with fixed price and cost reimbursement contracts under Part 49. In other words, contracts that are not contracts for commercial services and products under Part 12. And we'll start with an area where the requirements are largely identical for terminations under both kinds of contracts, and that's the prime contractor's duties when it receives a termination for convenience notice. So, when a contractor receives a termination for convenience notice, it has to do certain things, and we'll touch on a few of them here. So, first, it has to stop any work on the terminated contracts. It also has to transfer any title for materials and unfinished items to the government. It has to complete any work that hasn't been terminated. And it also has to submit termination inventory schedules to the government. And then for any subcontracts, first, it can't place any more orders under those subcontracts. It has to terminate all the subcontracts. And it also has to assign to the government the contractor's rights and titles and interests under the subcontracts. And then it has to settle any outstanding liabilities. And it has to settle any settlement proposals that are submitted by subcontractors for their work under the terminated subcontracts. So, the next issue that contractors that are faced with termination notices have to deal with is how are they going to get paid for the work that they've already done? Because a lot of times these termination for conveniences come unexpectedly while a contractor is in the middle of performing. So, for example, a contractor may be in the middle of producing widgets, and widgets is being used here euphemistically for any kind of deliverable, whether it's like a product or a service or some kind of consulting project, right? So maybe it's in the middle of producing widgets and it's already delivered and gotten paid on the first set of widgets. And it's in the middle of producing a second batch under a delivery schedule. Well, for the work that the contractor performed before the contract termination date, the termination rules for fixed and cost contracts allow the contractor to get compensated by settling with the government so that the contractor can be made whole for the time and expenses it incurred while performing. So, the termination for convenience rules for fixed and cost reimbursement contracts provide for a termination settlement or payment. And that payment may be the result of negotiations between the contractor and the government. And if an agreement can't be reached, then under the termination for convenience rules, the settlement payment will come from an agency determination by the contracting officer. And then lastly, in the case of cost reimbursement contracts, in some instances, the settlement payments are made through continued submissions of cost vouchers or invoices, and we'll talk about that in a few minutes. So, one side note here: for a contractor that's already completed its work and delivered it and gotten paid for it before contract termination, well, as long as the government has accepted the deliverable and the contractor has received full payment under the terms of the contract, well, there's no need to make the contractor whole because the contractor got the benefit of its bargain. So the termination for convenience rules are silent and they leave those pre termination payments alone. So the settlement process under the termination for convenience clauses and rules differs slightly for fixed price contracts and for cost reimbursement contracts. So we'll talk about them separately. Now, earlier we talked about the general underlying make whole principles. But for fixed price contracts, the termination for convenience rules are very explicit about how any termination settlement should end up, whether it's a negotiated settlement or one that's determined by the contracting officer. And specifically, the rules say first that a contractor should get fair compensation for the work that was done. Second, the contractor should get fair compensation for any preparations that the contractor made for any terminated portions of the contract. And third, a contractor should receive some reasonable profit or margin. And the caveat there that we'll talk about a little bit more later is if a profit was actually anticipated. Now, before we get too deep into the negotiation process, I want to touch on one category of work that a contractor is entitled to get paid for that's not part of the settlement payment. And that's for completed work that the government accepts and takes delivery of. So, getting back to our widgets example, if at the time of termination a contractor has widgets that it's completed, right? They're finished final products and there's nothing else that needs to be done. Well, first, an agency is required to inspect the completed items, and then the agency is required to accept any items that meet contract requirements or specifications. And then for any items that are accepted, the agency has to decide whether to take delivery of the items. Now, if the agency decides to take delivery of the accepted items, well, then it just pays out the contractor for the items at the usual price under the terms of the contract. And the completed items are not listed in the settlement proposal. And we'll talk about the settlement proposals in a little bit. Now, if the agency says, yes, they're acceptable, but we're not taking delivery of them, then the contractor can include the accepted but undelivered items in its settlement proposal. And it's entitled to list them at the contract price with some adjustments for things like freight savings and any credits if the items are actually sold. So we mentioned settlement proposals in that last slide, and typically settlement negotiations begin with the contractor submitting a final settlement proposal to get paid for the work that it already performed before contract termination. So the settlement proposal is supposed to be submitted within 1 year of contract termination, unless the contracting officer grants an extension. So, what should be included in the settlement proposal? Well, we already talked about completed contract items that were accepted but not delivered, and those should be listed in the settlement proposal at contract prices. And as we mentioned before, the general principles for fixed price contracts anticipate an allowance for a reasonable profit, and FAR 49.202 lays out the factors that an agency can consider when it's negotiating or determining a profit. So, a contractor should consider those factors when it's coming up with a proposal for a profit. Now, the rules also say that the agency should negotiate a loss if it appears that the contractor would have had a loss had the contract been completed, so a contractor should be prepared to negotiate any loss adjustment. And lastly, when it comes to compensating a contractor for the termination, the FAR clause in the FAR rules make it clear that what this means is reimbursing the contractor for its costs. And in fact, the FAR rule says that when submitting its settlement proposal, the contractor is supposed to cover all cost elements, and that includes settlements with contractors along with the proposed profit. And FAR Clause 52.2492 says that the Part 31 cost principles are supposed to apply to all costs that are claimed and negotiated. So, what this means is that a termination notice effectively converts a fixed price contract into a cost contract for purposes of compensating a contractor for the work that it was already performed. Now, accepting the delivered items that are entitled to be listed at full contract price, which we talked about before. Now, in terms of what cost elements a contractor should include in their proposal, well, contractors can look at two places for guidance. First, they can look at FAR 31.20542, which sets out termination costs that are allowable under cost reimbursement contracts. But they can also look at the rules in FAR Clause 52.2492 that apply to settlements that are determined by the contracting officer when there is no agreement, because those rules set out the mandatory costs that a contracting officer has to reimburse a contractor for. And these mandatory costs should then set the floor for what a contractor claims in its proposal. Now, getting into the weeds on the settlement costs that a contractor can or should claim is beyond the scope of this presentation, but briefly, these costs can include subcontractor settlement costs, costs that are attributable to the settlement itself, like legal and accounting costs, and the costs related to preparing the settlement proposal. They include costs to store and transport termination inventory, and they include certain indirect costs, like salary and wages that are related to the termination. So, a few more points about setting out costs in the settlement proposal. Now, like I said, all costs should be determined using FAR Part 31 allowable cost rules. But in terms of how to present those costs in a proposal, the FAR rules lay out two options or formats. And again, we aren't going to get too far into the specifics here. So, first, there's the inventory basis format. And this is the preferred format. And here, the contractor breaks down costs into specific elements like raw materials, costs for purchased parts, finished components, and costs for works in progress. But there may be some limited circumstances where the inventory basis may be too cumbersome or not applicable, like when production work hasn't even started, or the contractor's accounting system doesn't break out unit costs for the work that was performed. So, an example here could be where the deliverable is just a report, maybe a feasibility report that the contractor is paid a fixed price to write, and where the contractor may not have separate cost items for parts and materials. Well, in those circumstances, a contractor can submit its proposal using the total cost basis. Now, one last thing to note is that despite the naming conventions, both formats provide a line item or schedule that allows the contractor to quantify or specify the direct labor that was used during contract performance. So, as we mentioned, if the contractor and the agency can't agree on a settlement amount to be paid because of the contract termination, well, the contracting officer can make a determination on what should be paid. But in that instance, the contracting officer has to pay the contractor certain amounts. So, first, the contractor has to receive payment at the contract price for all the items that were accepted by the agency. Next, a contractor is entitled to payment for the costs that it incurred to perform work, including any initial or preparatory costs that the contractor incurred in order to perform the work. A contractor also has to receive payment for the costs that it incurred to settle and pay any subcontractor settlement proposals for the work that subcontractors performed on their terminated subcontracts. And then a contractor also has to receive payment for a fair and reasonable profit. Again, unless it anticipated a loss, in which case the contracting officer can make an adjustment for the expected loss. And then lastly, a contractor is entitled to receive payment for reasonable costs that are related to the settlement of the work that was terminated. And here the FAR rule says specifically that these costs can include accounting, legal, and clerical expenses that are necessary to prepare the settlement proposal. They can include costs related to terminating and settling subcontracts, and they can include costs related to the storage and transportation and other costs needed to deal with termination inventory. So, moving on to cost reimbursement contracts. The settlement process under the termination for convenience clauses and rules for cost reimbursement contracts is a bit more simplified and straightforward. And that's in part because not a whole lot changes as a result of the termination notice. So, the general rule is that with respect to the settlement, the cost clauses that are already part of the contract determine what's allowable. And those clauses obviously incorporate the allowable cost rules under Part 31. And in fact, the rules say that a contractor can continue to submit its normal SF 1034 invoice or payment vouchers for up to 6 months after contract termination. So, as a practical matter, a contractor may be able to settle out all of its reimbursable costs for the work that it did before the termination just by submitting payment vouchers for those costs during that 6 month window. Now, if a contractor is working under a cost contract with a fee component, like under a cost plus fixed fee contract, and it goes this route and it gets fully paid out during the 6 month voucher period, well, the contractor can request a settlement of the fee by submitting a certified letter or by including a fee claim in its settlement proposal. And likewise, if there are any costs that are related to the work under the terminated contract that the contractor did not submit a voucher for during the 6 month window, well, the contractor can include those costs in its settlement proposal. So, as with terminations of fixed price contracts, under a cost reimbursement contract, a contractor has 1 year to submit a settlement proposal unless it obtains an extension from the contracting officer. Now, as for the settlement proposal itself, well, for any unpaid work as of termination, a contractor should include costs that were not previously vouchered. And again, because the contractor was already getting paid before the termination on a cost basis, coming up with an amount that covers unpaid pre termination costs isn't going to require any major shifts in how contractor quantifies the work that it performed. Now, as we talked about before, a contractor should also include a claim for fees if the contract had a fee component. And here again, in setting a floor for what it might propose, a contractor can look for guidance to the settlement by determination rules in the FAR clause that mandate a fee payment and how the contracting officer should calculate it. Now, those rules generally require that the contracting officer pay a fee that's proportional to the work that was completed. So, lastly, a contractor should include a claim for settlement expenses. Again, looking at the FAR clause's rule on mandatory settlements in settlements by determination as a floor. But as with fixed price contracts, a contractor should also look to the Part 31 cost rules on allowable termination costs because those rules include indirect costs, which are not mentioned in the FAR clause's provisions on settlements by determination. So, as with terminations of fixed price contracts, a negotiated settlement agreement for a cost reimbursement contract can settle all or part of the amount of costs and fees that arise from work under the terminated contract. And if there's an agreement, then the contract will be modified and the contractor will be paid the agreed amount. So we'll quickly go over settlements by determination for cost reimbursement contracts. Now, again, if the contractor and the agency can't agree on a settlement amount to be paid because of the termination, the contracting officer has to determine the amount that's due and that amount has to include certain recoveries for the contractor. So, first, they include all reimbursable costs that have not been paid out. Second, they have to include the costs of settling and paying subcontractor settlement proposals. And they also have to include unpaid fees. And as I mentioned before, the terminations for convenience rules say that the contracting officer has to pay fees in proportion to the work that the contractor completed. And lastly, they include expenses related to the termination settlement itself. Now, the FAR clause mentions three categories of settlement expenses, but as I mentioned before, they don't mention indirect costs for salary and wages that are related to the termination settlement, which are mentioned in the Part 31 cost allowance rules. But I think the FAR clause can be fairly read to mean that a contracting officer has to pay settlement costs that include, but are not limited to, the ones that are mentioned. So, the last termination for convenience rules that I want to talk about today are the rules on contracts for commercial products and services under Part 12. Now, Part 12 rules and FAR clauses that apply to Part 12 tend to be more streamlined and slimmed down versions of the rules and clauses that apply to non commercial contracts. And we see that with the rules on terminations for convenience. So, straight away, the rule under FAR 12.403 says that the termination rules under Part 49 don't apply to Part 12 contracts, and that contracting officers should follow Part 12 procedures. Now, it also says that contracting officers can look to Part 49 as guidance, but if there's a conflict with the Part 12 rules, they need to follow Part 12. Now, as for Part 12 rules on termination settlements, well, there really aren't that many. On the settlement agreement, all FAR 12.403 says is that in general, the parties should agree on the proposal. And the parties must balance the government's need for documents supporting the payments against the goal of a simple and expeditious settlement. So you can expect a quick turnaround and a limited exchange of documents. So, for example, on a commercial monthly contract like a monthly maintenance contract, where the government decides to terminate at the end of the month, well, if the government quickly agrees to pay up through the end of the month, there may not be much to settle up, and the contracting officer may already have all he or she needs in the contract files. So the rules on settlement payments are just as sparse. All they say is that for fixed price or fixed price with economic price adjustment contracts, the contractor has to be paid a percentage of the contract price that's proportional to the work that was performed as of the notice of termination. And then for labor hour contracts, the contractor has to be paid direct labor hours that are multiplied by the hourly rate in the schedule. Now, in addition, the contractor can recover charges that directly result from the termination. And here again, in the interest of expediency, the rules say that the contractor can support the charges with information from its standard record keeping system, and it doesn't have to meet either the cost accounting standards or the Part 31 principles. So the rule doesn't specify what particular termination charges a contractor can recover. But although the contractor doesn't have to meet the cost accounting or Part 31 cost principles, a contractor should be able to look at the kinds of settlement expenses that a contracting officer has to reimburse it under the Part 31 terminations for fixed price and cost reimbursement contract rules as guidance for what it may claim under the Part 12 termination. And then lastly, the rules say that the government doesn't have a right to audit the contractor's records simply on the basis of the termination for convenience. The last issue that I want to talk about that contractors should be mindful of relates to deobligation. So, the Part 49 termination rules talk about releasing excess funds. And these releasing rules apply to all Part 49 terminations. So, they cover both cost and fixed price terminations. And then the rules say that after a notice is issued, the termination contracting officer, and that's the contracting officer who handles the day to day contract termination issues. Well, the TCO has to estimate the amount of contract funds that would be needed to settle the termination. And then it has to provide a recommendation to the contracting officer to release and deobligate the excess funds back to the agency. Now, once that happens, the funds are deobligated on a timely basis. Meanwhile, as the settlement process progresses, the TCO is supposed to monitor the funds. And if the prior release results in a shortage of the amount that's required to fully settle the termination, the TCO is supposed to inform the contracting officer, and then the funds will be reinstated within 30 days. Now, especially in today's environment where agencies seem to be in a rush to terminate and recover contract funds, well, contractors have to be on alert to any proposed settlements that require them to sign off on deobligations. First, if they're asked to agree to deobligate funds, a contractor should have some sense as to how much funds are still available under the contract and how much funds might still be needed to cover the settlement, and that might take some time to figure out. And second, contractors should always preserve or at least remind the contracting officers of the contracting officer's obligation to reinstate funds if there's a shortage. And contractors should avoid waiving that requirement. And then lastly, contractors should keep in mind that if there is a deobligation, the reinstatement process may add at least a 30-day delay for any payments that are claimed during a shortage. So that may be another incentive not to agree to a hasty deobligation proposal. So I just want to end with a few key takeaways or best practices. So, first, contractors should engage any outside help, whether it's accounting help or legal help, as early as possible. Because in some instances, especially in today's environment, contractors may be asked to submit settlement proposals on an expedited basis. Now, it's not uncommon nowadays for termination notices to request settlement proposals with a 1 week turnaround. But even under commercial contracts, that might not be enough time to get all of the cost information that a contractor needs. So, contractors should be able to push back against any unreasonable deadlines while getting the help they need as soon as they can. Now, secondly, contractors need to get termination notices to their subcontractors quickly so that they can stop performance on the termination effective date. And then lastly, as soon as possible, or even before the initial shock of a termination notice begins to wear away, contractors need to quickly jump into cost recovery mode. So, although the government has the right to terminate a contract at any time for its convenience, contractors have a right to recover every last penny that they're entitled to recover as a result of the termination. So, for fixed price contracts, that may mean being ready to quickly switch to a cost basis to substantiate the work that was already performed. And then for contractors that are spending significant time and resources to deal with the settlement, well, they're entitled to recover those costs. And that may mean that they should consider assigning time tracking codes for every person who's going to do work on the termination settlement, for example. Now, anecdotally, and this really shouldn't happen, but there are stories out there of agencies terminating contracts within a month of termination with settlement costs that far exceed those last remaining installment payments. And remember, on a fixed price contract, the contract price ceiling doesn't limit the recovery of settlement expenses. So again, a contractor needs to be able to turn the switch on and have those cost recovery mechanisms in place in the event that it gets a notice of termination. Well, that's all I have for today's webinar on terminations for convenience. I want to thank everyone for listening. And if you have any questions on any of the information that we've gone over, my contact information is up there on the slide. So feel free to reach out with your questions. And thanks again.